Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Turning to deals, TikTok saying it reached binding agreements for a new U.S. joint venture, majority owned by American investors. The company's CEO telling employees agreements with Oracle, Silver Lake Management, and MGX have been signed. Joining us now as we parse through everything that has happened in 2025 around the trade story is the 20th U.S. Trade Representative Jamieson Greer. Representative Greer, I want to start on how busy 2025 really was. Looking ahead to 2026, do you expect the same kind of pace with respect to trade deals, with respect to trade announcements?
Well, during 2025, President Trump, the administration, has essentially reset the global trading order to move from total liberal trade in the United States without any cost to a new, fair, and balanced approach. We've announced lots of trade deals. We've announced lots of tariffs, as you know. In the coming year, we expect to finalize a bunch of those trade deals as well. I think that the tariff plan is in good shape. I think we have a lot of the tariffs we want in place. If there are countries here and there that don't comply with their deals or don't want to finish a deal, then maybe we have to have another conversation. But I think the economy's booming, inflation's down, wages are up. We're on a really great track.
How much are you potentially at risk should the Supreme Court overturn some of the tariffs that have been enacted under the IEEPA provision? Do you have something in place to get those tariffs through other measures, or will there be a rethink about what will be put on and what won't?
Well, it would be terrible if the Supreme Court overturned the case, because we have built a new global trading order on the back of these tariffs and the tariff system. And our trading partners have accepted it, and they've made deals, and they've accepted there's going to be some tariff level to help protect U.S. industry. So it would be disastrous if this was pulled out. All that being said, we will do whatever we need to do to make sure that we can maintain the tariffs we need and keep the deals in place. Obviously, we want the flexibility of the emergency powers that Congress has given to the president. It's the most effective way to deal with it. It's what's made him so effective this year in negotiating. But absent that, we'll work and we'll find a way to make sure we can keep all these gains we've made over the past year.
Representative Greer, there's also a feeling right now that cost of living concerns are coming to the fore, and President Trump has talked about removing some of tariffs on specific goods, particularly having to do with food, as a way of alleviating some of the price concerns. How does that factor into discussions going forward? Do you think that will be an increasing part of your thought process as you go through some of these trade negotiations?
Well, any good president wants to address affordability, and our president is. And over the past month, we saw, dairy, fruit and vegetables, all kinds of prices go down for basic staples. So that's a great development. Going forward, the president removed some tariffs in connection with some deals related to food coming from abroad, bananas, coffee, cocoa, the kinds of things we just don't make in the United States. The United States is a food powerhouse. When we saw inflation earlier, it's really about housing, healthcare, driven by Obamacare disaster. So I don't think that, food imports are really going to be an issue for us. The tariff program is really about creating jobs, and the president's regulatory approach is really about bringing prices down and bringing affordability.
Ambassador, have you had any specific directives from the president, though, as you carry out your negotiations to make sure any tariffs you put on from here, or any ones that you negotiate specifically, are not having an impact on affordability? The way you put it there, a specific direction, I would say no. Whenever we're imposing tariffs or doing deals, the purpose of the trade program is to reshore American manufacturing and protect American food security. It's really about jobs and increasing wages, which we've seen over the past few months. When it comes to prices, the president is undertaking a lot of other actions, energy policy, tax policy, regulatory, gas prices are down, et cetera. So we don't see the
trade policy really is driving prices. We see it as driving jobs.
Ambassador, I'd love to go back where Lisa started, and that is it looks more likely that we indeed have something of a TikTok deal where U.S. buyers will take the American portion. You, after some of the negotiations in Madrid, were talking about how this deal, how this company was part and parcel of a variety of matters when it comes to negotiating with your Chinese counterparts. So have you had more discussions about this deal with TikTok? Does it seem likely that China will let it happen?
So there are two layers to the TikTok deal. One is the private sector layer, where the private parties are concluding a deal. And then there's a layer of government approvals between the United States and China. And so my conversations with the Chinese government over the past few months, as you mentioned, have covered a variety of issues. One of them has been TikTok. Back at our discussions in Madrid, we came to an essential agreement that if the private parties came to agreement, that the Chinese would approve it. So we expect approval by the government of China in alignment with that agreement we reached earlier this year.
We're hearing about not only this deal with respect to TikTok and some investors in the U.S., but also a review process to sell H200 chips into China. And I'm just wondering, stepping back, if all of these are pieces of a bigger deal that will come to fruition in 2026 between the U.S. and China.
I would say with the H200 export control issues, those really are standalone. That was not a negotiated outcome in the United States with respect to export controls. Those are not something that are really subject to negotiation. Those are national security and commercial decisions made by the federal government. So that's kind of standing on its own. With respect to the rest of the China deal, right now we're trying to make sure that rare earths continue flowing from China. They've bought over 5 million metric tons of soybeans at this point, and we're trying to keep trade flowing between the two countries in a way that makes sense.
Do you expect a bigger deal other than just sort of steady reset kind of idea that we've talked about with respect to the U.S. and China? Do you expect something more comprehensive to be outlined next year?
It's a little hard to say at this point. Goal one is stability. For me, and everyone's heard me say this before, we need trade with China to be much more balanced. Our trade deficit with China has decreased by 25% this year alone under President Trump's policy, so that's going the right direction. I can foresee a situation in the first half of next year where we come to some kind of agreement with China on exactly what we should be trading with each other, and even in what volumes. It's a little bit of managed trade, but it's the kind of thing that can be healthy and stable. Given the way that Chinese government runs its economy, it just doesn't mesh very well with the way we want to run our economy. That just means we have to manage it a little bit more, and I think there's a possibility of that. I'm not sure I'd call it comprehensive, but I'd call it confidence building.
Ambassador, I think a lot of the confusion for many people comes around national security. One of the points that you mentioned just a moment ago, especially things with H200 chips, giving chips to China was seen an issue of national security, even giving F-35s to Saudi Arabia. What does that mean for national security? Because critics would say that it means that national security is up for sale. What would you say to those critics?
So with respect to the F-35s, that's not my. I used to be in the Air Force, but it's not my wheelhouse. On the H-200s and export controls generally, export controls have always been fluid. They've never been static. The very nature of export controls is that the U.S. government is constantly reviewing the state of technology and assessing what technologies can be sold and which ones can't, and balancing national security and assessing whether or not there's foreign availability. Everyone knows that the Chinese are quickly also trying to develop their own AI chips, semiconductor tools to make those chips, etc. It's a race. All of those H200 approvals still have to go through the Commerce Department to make sure that any licenses that are granted really respect U.S. national security and make sure that it's not violated, and there can be conditions on licenses, etc., to make sure they go to end users and end uses that don't jeopardize U.S. national security.
Is it fair to say then, Ambassador, that even if this does go through, the kind of cases where this is allowed, where it's approved, will still be quite limited in scope?
So it's hard to say at this point. That these types of license applications are typically case by case and reviewed. So we'll see. The way it's set up right now is if the chips are going to go to China, they come back to the U.S. for a security inspection to make sure that they are indeed the types of chips that are being allowed to be sent to the Chinese. We know there are a lot of Chinese companies that want them. We know the Chinese government's pretty interested in having their own domestic champions build them. So the Chinese themselves right now are having a conversation about the types of chips that they want from the United States. We think that they want the H200s. They've shown an interest in that. So we'll see, between their process and ours, we'll see where it goes.
It seems like the tech wars have been behind a lot of the negotiations over the past 12 months, in particular, not only with China, but also the European Union. I'm just wondering where some of those discussions are with respect to some of the restrictions and regulatory investigations Europe has been making toward U.S. tech companies. Where are some of those discussions?
So I just had a conversation yesterday with my counterpart in the European Commission yesterday to reinforce some of the strong concerns we're hearing from U.S. stakeholders. U.S. tech companies are the most competitive in the world. And Europe, frankly, doesn't have those types of competitors. If you talk to the Europeans, they'll say that's why we have to regulate and have these protectionist measures against U.S. tech companies. Unfortunately, we see in the way that they've developed those measures, they're discriminatory. They only capture companies above a certain threshold of revenue globally or certain business models, and magically it only happens to capture U.S. companies. They'll say that they're Chinese companies too, but we only see actions against American companies. So it's a problem. It's discriminatory in fact. You'll hear the Europeans say, well, it's fair, but it's discriminatory in fact and in intent. So I want to talk to these folks. I want to negotiate over it. They've been somewhat resistant to that. But again, I had a great conversation yesterday with the European Trade Commissioner, and I think we just have to be able to talk about why they're doing this, why they're purporting to regulate American companies and their global business models.
Ambassador, coming into 2025, a lot of people were wondering who our allies and who our adversaries would be on trade. And we were talking about who traditionally have been U.S. allies and who haven't. Have you been surprised at who's been most difficult to deal with in 2025? It has surprised a lot of people in the markets to see the likes of Europe be a more contentious discussion than other regions, even sometimes China.
That's because they haven't been trade negotiators. I have not been surprised at where it's been more challenging. Take India, for example, who's an important partner and a strategic partner in a lot of ways. We started negotiating with them early in the year, and we're still negotiating with them to try to find a good landing zone. During that time, we have other trade partners who have come in, started, proceeded with, and concluded trade negotiations with us, et cetera. The reality is somebody like Europe, and frankly, some jurisdictions that want to emulate them, they might have relatively low tariffs compared to the rest of the world, but they have non-tariff barriers, regulations that exclude American agriculture, which is one of our major exports, and regulations that exclude our industrial exports. And so you get into and this is why we have giant imbalances. It's not because Europe is really competitive. We know they're not. It's because they have a lot of these rules that prevent U.S. goods and services from going into the continent.
Ambassador Greer, just to finish up on Mexico, which has been negotiating from what we understand. They just recently gave final approval to put tariffs on certain Chinese imports, and a lot of people are expecting there to be some sort of reprieve with respect to aluminum and steel tariffs on Mexico. Is there any discussion about that going on right now?
So first of all, any country in the world who exports steel and aluminum to the United States wants to have a modification to that regime, because the United States for many years has been the consumer of last resort. And this is why the president put steel and aluminum tariffs on in the first administration. The Biden administration kept them, and the president has tightened them further in his second administration. Of course, the Mexicans are asking for this. We have found the Mexicans to be quite constructive in some of our recent discussions and looking to change some of their laws and regulations related to longstanding U.S. concerns. So have the Mexicans asked about this? Yes. I won't give any further detail beyond that, but it's certainly something that they would like to see.
Stay with us. More Bloomberg surveillance coming up after this.
Ohsung Kwon of Wells Fargo joins us now. Ohsung has a bullish forecast for next year in the equity space, and it comes to this question of how much does the data even matter if you have a Federal Reserve that is biased to cut rates and a federal government that is biased to run this economy hot?
Yeah, I think the setup for equities into 2026 is pretty favorable. The profit cycle is still in an up cycle. We're forecasting 14% growth, EPS growth for the S&P next year, followed by another 13% in 2027, I think liquidity, which we talked quite a lot about, that's going to improve quite a lot in Q1 with the Fed starting to expand its balance sheet. It was a lot sooner and a lot bigger than what we had previously forecasted. And with that, we're going to see a huge uptick in the liquidity environment overall. And I think that's really going to be the bull case for equities as we move into 2026.
But I hear people screaming at the television screen. This isn't actually quantitative easing. This is just trying to ease the technical backdrop for banks that are using the Fed as some sort of backstop. So how does this really increase liquidity? Is this more of a boost to liquidity than some people are accounting for?
I mean, it depends on how you define QE. If QE is really about shortening duration, then it's not a QE. But if QE is about boosting liquidity into the system, because the funding market was really seeing a lot of stress. If you look at the SOFR spread between the SOFR rate versus the Fed funds rate, it blew up back in October to as much as 35 basis points. So there was a real stress that we saw back in October and November in the funding market. I think that was really the main culprit for the sell-off that we saw over the past or the volatility that we saw over the past 6 weeks or so. And looking at things like Bitcoin, quantum stocks, non-profitable tech, those guys sold off the most, and that's essentially what happens when liquidity dries up. Everyone's risk curve shifts to the left, and the assets that are farthest out the risk curves, the most speculative assets, they get sold the most. I think with liquidity coming back and potentially liquidity conditions overall being actually good in Q1, I think speculation is going to pick back up. I think AI trade is going to work more in the second half of the year than we're thinking. But I think the overall equity market is going to be pretty bullish.
Is that why you have the assumption that into next year, you write in your research that inflation reacceleration is going to be worse for equities than a recession would be? Because a lot of people would look at the dichotomy between the two and say inflation coming off the back of COVID, equities still did well, but it's growth that's really in earnings that's underpinning this equity market. And if we get a recession, then that would be worse.
Yeah, I mean, if I have to think about the probability of recession and inflation, I would assign a higher probability of inflation. I'm not too concerned about inflation either, because I think there's that AI productivity disinflationary pressure that's going to keep inflation pretty low. But there's the physical as well as monetary policy that's coming back in to potentially drive inflation higher. So if I have to choose, I would say inflation has a higher potential than recession. But I'm not too concerned about it either.
But inflation would be worse for equities than a recession would be at this point.
I mean, both would be bad. But I think the probability of inflation is probably higher than probability of recession at this point because of fiscal. We estimate about 80 basis points of GDP contribution for the full year 2026. Most of that is happening in the first half of the year, really through the tax return. So I think consumption is going to pick back up. Consumption is 70% of the economy. So I'm not too concerned about the economic downturn.
What's the sort of break the glass moment in the yield space for equities? And I ask this as you do see longer term yields globally creep up on the backs of a hawkish move from the Bank of Japan, albeit whatever people are thinking in the currency space, but also this idea that the ECB is getting to the end of their easing cycle. How much do you see this sort of line in the sand, let's say at 4.5% for the 10-year, at 5%, where suddenly the bull case just isn't there?
Yeah, I think it's going to matter more for what works within the equity market. So we're more bullish on the reflation cycle into the first half of the year because of the fiscal stimulus that we're going to get. But if rates climb above 4.5% or so, I think that's potentially what kills the reflation cycle and potentially back into AI. I think closer to 5% is going to be actually pretty bearish for equities.
So in this bullish environment for 2026, the speculative stuff starts doing well again. Is that a healthy bull market? Is that a healthy turn in the continuation of the gains we've seen in equities?
I think, the bull markets typically have a little bit of speculation at least, especially in this AI cycle. There is going to be speculation. It's new technology, and I don't think it's a bubble yet, but I think there's a potential it becomes a bubble in the second half of the year, especially with the Fed continuing with this easing cycle, liquidity being more ample. And I don't think the AI trade is over. I mean, there's quite a lot of concerns around AI CapEx, and because the market started pushing back on hyperscalers CapEx, there's consensus view is that hyperscalers are going to moderate its capex, and that's been basically what drove the semi and the AI infrastructure sell-off over the past week or so. And if you look at semis versus hyperscalers, over the past week, we have seen a 3.5 standard deviation move, meaning hyperscalers outperform semis by 3.5 standard deviation. And that trade has been diverging. If we start to see hyperscalers sort of reiterating their capex outlook, the funding issues that Oracle and OpenAI are having, those concerns ease going forward and liquidity comes back, I think the AI trade is going to be back on.
Stay with us. More Bloomberg surveillance coming up after this.
Joining us now is Heidi Crebo-Rediker of the Council on Foreign Relations. Heidi, thank you so much for being with us. You recently wrote a piece about how the structure of financing the European Union agrees on for Ukraine matters. So what have we learned overnight when it comes to the structure they have laid out?
So, I mean, first of all, there was not a question in my mind as to whether or not Ukraine was going to get the financial support from the EU. It was just basically how. And they did it through collective borrowing, which I think, it's a step towards mutualized debt. But it's not. But it is absent, three of the EU countries, namely Hungary, Slovakia, and Czech, and. So I think on the one hand, that's good. They came through with the 90 billion. This is just from a timing perspective. I think it had to happen because the IMF is finalizing an $8.1 billion loan to support Ukraine, and there's a huge gap in their financing, and so the EU really needed to step up to provide support, and the 90 billion is going to go a long way there. It's not all the way there because I think the gap that is projected over the next 3 years is 136.5 billion, which is huge, and but this is a big step in the right direction. It also, I think Oliver pointed out, it's an elegant solution in a way because it takes it takes the burden off of individual countries to actually provide the budget finance from their own individual budgets. So there is a bit of a collective shift, but at the same time, it would have been a lot more powerful to use the Russian sovereign assets. This was something they've been negotiating it for a very, very long time. And it was, I believe, politically a big failure for Chancellor Merz, so this didn't get done.
And that's something that Ukraine and Zelensky had been arguing, that it becomes a powerful negotiating force if they were to use the frozen Russian assets. Heidi, on the other side of things, the Belgians had been arguing that it would face legal retribution and just retribution in general if they had used these Russian funds straight up. Is there any merit to the arguments coming from the European capital?
So, Belgium, I think at the end of the day, just really didn't want to do this. They had a lot of popular support in not moving forward to use these immobilized Russian assets. And Euroclear obviously, has the Russians just sued for, in case Euroclear was planning to use any of these assets, even though the structures that were being discussed would have taken the legal burden away from both Euroclear and Belgium. But at the end of the day, this is something where Merz was standing by himself. France and Italy went lukewarm and did not support him, and Belgium just pushed through and decided that this was something that they cared a lot about. I'm of two minds. I think that the EU needs to move towards collective borrowing for its own national security in order to be able to fund, for example, its own defense. But for this, it just needed to get done, and it got done by hook or crook.
What does it change, if anything, Heidi, though, to the political situation of the very highly indebted nations of France, of Italy, of others?
Well, this is going to be a burden on them, and ideally this would have been, an exercise where you didn't have to have any additional funding coming from in particular, countries like France and Italy, and others that are, that are struggling that don't have the headroom to really borrow or put too much up to support this loan. It's unfortunate because they had an opportunity to actually use a sizable amount of Russian funds, and they weren't able to get there.
Stay with us. More Bloomberg surveillance coming up after this.
Stocks slightly higher as Wall Street looks to end the week with a win. Anastasia Amoroso of Partners Group writing, "We don't believe investors should give up on AI into 2026. The current pullback may present opportunity." Anastasia joins us more. Anastasia, great to see you.
Good to see you.
Very much the holiday spirit, I see.
Yes, I brought the holiday spirit.
I think it's great. So coming up, it does feel like people over the past couple of days at least have come back to this idea. Maybe the sell-off is a good thing. It highlights skepticism. It highlights a better entry value. Where are you on that? What have we seen over the past couple of weeks that gives you more confidence?
Right. Well, first of all, as you were saying, maybe the volatility is normal as we get higher and higher at market altitude, so to speak. So maybe that is what we should be accustomed to seeing in 2026. Investors scrutinize things more, and investors question things more. So maybe that is, to your point, a healthy development. I do think it's nice to see the AI trade pull back by 5 or 7 percentage points over the last couple of weeks. Having said that, as I look at what's really driving the AI trade, it is demand, the adoption, it is productivity, and it is monetization. And when I look at all three of those categories, I see positive developments there. First of all, let's talk about adoption. Around this table, I'm sure you're using more AI now versus what you did at the beginning of the year. And if you look at kind of the adult population in the United States, 55% is the percentage that use artificial intelligence today. That was about 45% to start the year. We went from a 10% adoption rate economy-wide to about a 17%. So we are moving up that adoption curve, which is great. The second thing, Lisa, that I looked at the other day was the productivity increases. Coming into the year, we were sort of expecting to see the productivity gains due to artificial intelligence. And when I look back at the last, call it 3 years, you have actually seen measurable productivity gains. Productivity has been average about 2% year-over-year growth versus 1% that we saw in kind of the decade, after the financial crisis. So these are not just wishes; these are tangible productivity gains. We hear that from companies. We see that in our portfolio companies as well. And then the last point, it's all about the monetization. And there too, whether you look at cloud revenues, whether you look at some of the AI LLMs, the likes of OpenAI, their revenues are surging. And I think that trend can continue into 2026. So with all of that, the AI trade is priced better today. So I would step in here for 2026.
The AI trade in pockets, right? I mean, are there areas that are the winners and areas that are the big losers as you do see a consolidation of profitability in a select number of cohorts, right? I mean, at what point is the gain of some players the pain of everybody else? And I point to Micron yesterday doing really well because guess what? They can charge a whole lot more for their chips.
Right. No, that is a really good point. It's not going to be just everybody is a winner. It's not the tide that lifts all the boats. And that's what we think about in our investment committees. We think about whether a company is going to be disrupted by artificial intelligence or is actually going to be helped by artificial intelligence because they're quick enough to embed it. So that's one way to think about it. The other way I would say, Lisa, we should actually draw the distinction between, no, I don't think AI is a bubble, but are there signs of bubble-like valuations in certain parts of the ecosystem? Absolutely. I mean, if you look at, for example, the late-stage venture valuations for AI companies versus non-AI companies, they're trading at a premium of something like 250%. It's not the case for earlier stage, but it is the case for later stage. So I think you have to have a question mark around those valuations. But we are finding, I think, winners in artificial intelligence, I would say, in several different categories. The first one is infrastructure. And the shift is now really sort of, yes, we've done data centers for the last 5 years, but it's really more of a focus on energy because, that's the bottleneck. We also think about investing in AI companies that have proprietary data. They have vertical expertise and they can leverage that. That's what we think gives them the competitive moat and the best chance to embed artificial intelligence and kind of, invent AI-powered services. And then the last thing is across our portfolio companies, we also have a concerted effort to boost productivity, drive revenue growth, and also enterprise value creation by infusing AI. So that's where we identify the winners. But you're right, there's going to be lots of disruption, lots of companies to avoid as well.
How much of the avoidance doesn't just have to do with, are you producing revenue? Are you being disrupted by it? And maybe there is promise there, but debt loads are getting unmanageable. I mean, Oracle's been the poster child for this, where their spending increases 11-fold and their cash growth has turned into an outright cash burn. You can pick into any company, but even if the promise is big to you, do debt piles like that and cash burn make it enough to make that kind of company no longer attractive?
I mean, look, once again, I think investors should look at Oracle and the likes and scrutinize anybody who is quickly taking on debt and maybe not scaling revenues quickly enough. So I do think that's a healthy development. But when I think about, let's say, the rest of the hyperscalers, they don't have the issue that the market is sort of punishing Oracle for. They have plenty of free cash flow. They have plenty of cash on the sidelines to finance the data center spend. So, and the other thing I would point out, Danny, going into 2026, I certainly would not give up on all the hyperscalers, because what you actually see is their earnings trajectory keeps on accelerating towards the tail end of 2026. And we talk about this gap narrowing between the Max 7 versus the 493, but that gap is actually going to widen out once again for most of the Max 7, perhaps not the specific companies.
But even for the hyperscalers, and specifically the LLMs, the Googles, OpenAI, why isn't it just a Google being the ultimate winner? Because they have the ability with their balance sheet to not charge for their AI models. Why not just run OpenAI into the ground with the inability of them being able to produce revenue, of Google just offering it for free, and then once they're gone, then maybe they can turn around and become a monopoly? Why isn't that the future road that this might go down?
Well, you bring up a couple of good points. Google, first of all, has been investing in artificial intelligence and working on developing artificial intelligence for years, prior to OpenAI. So Google, by all means, should be one of the winners of this AI trend. But the other point I would say is, whether it's Google, whether it's OpenAI, whether it's another platform, it is about that. It is about the platforms. I remember, talking about artificial intelligence back in 2019, and the biggest winners were always going to be the providers of the picks and shovels of AI and a lot of these LLM models. And who's that going to be? Those who have the massive treasure troves of data. And so it's the likes of Google and Meta and others. So I'm not surprised to see, perhaps Google kind of be in the lead once again, as I think they kind of were back in 2019.
Anastasia, there is a big discussion around if there is risk building. And yes, sure, there is risk building, but the question is where. Most people have pointed to private markets as a place of potential risk. I know you're focused on financing companies and financing infrastructure projects through the private markets. How much risk do you really see building heading into 2026?
Right. Well, if you take a step back, Lisa, if you think about the sheer growth of private credit, for example, it went from being a $600 billion asset class to a $1.7 trillion asset class. So by the sheer kind of virtue of growth that we've seen, there's going to be more and more risks. And I think that's what we've seen is some of these idiosyncratic headlines are representative of the growth of the asset class. But when I think about it from the interest coverage ratio perspective, for example, yes, it is, dipped from where it was pre-2022, but it's actually troughed and is starting to improve. So the fact that the Fed has cut interest rates actually alleviates, I would say, some of the pressure on private credit. I think what you have to look out for is, there's been lots of money raised in private credit. That money had to be deployed quickly. And, in some cases, it was deployed in large chunks of capital. So was it always appropriately deployed? Was it always properly covenanted for everybody? I don't know. But for us, if we look across our private credit platform on the U.S. side and the European side, on average, I would say 90% of the loans that we've done have a covenant attached to them. So I can't speak for the industry as a whole, but I think, if you had the prudent underwriting standards, despite the growth in the industry, we're in a good place today.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.